We speak often about building a stock portfolio, and we discuss what stocks should be in that portfolio. But on this program, more often than not, we're talking about your mutual fund strategy. Today, I'd like to talk about the pros and cons of building a stock portfolio, whether a dividend portfolio, as some people desire to build, is actually something that you should consider doing. Joining me is Mohit Gang, who's the co-founder and chief executive officer of Moneyfront, and Sudhir Kaushik, who's a chartered accountant and chief executive officer and co-founder of Tax Spanner. Thanks so much, gentlemen, for taking the time. Mohit, I'll come to you first. A lot of people desire to have a multi-bagger portfolio. It's easier said than done. What are the pros and cons, in your opinion, of building a stock portfolio?
Thank you, Alex. Thank you for the opportunity. Always a pleasure. Look, I'll just start with a small analogy. If you go out in the market and pick up a fruit for yourself, you need to know the right contents, the right nutritional value, the right seasonality, the right thing, the ripeness of the fruit to pick it up. If you think you can't manage all that, then you perhaps rely on an expert who can serve you a fruit bowl or a fruit salad, and then you might just not like few things in it, but you will still on a whole be satisfied with it. So that's the difference between a stock picker and a mutual fund guy. It's a crude analogy, though it serves the purpose in a sense that if you understand the nitty-gritties of what drives the market, liquidity, emotions, fundamentals, valuations, everything, then yes, by all means, you should have a direct stock portfolio. But if you think you can't do all that along with a job or a side hustle, you can't manage the rigors of being on the screen, tracking the ups and downs, tracking the movements, tracking the ratios day in and day out, then you perhaps rely on experts whose job or whose daily bread and butter is about delivering good returns for you, and that comes through a source of a mutual fund, right? So again, it's anyone's call out there, but if you think you can manage, do it yourself. If you can't, then yes, by all means, just go ahead and rely on the experts through a mutual fund.
Got it. And there's no reason why you can't do both, right, gentlemen? So you can have a small portion if you want, if that scratches the itch, so to speak. Sudhir, from a tax perspective, and that's the primary reason why I have you on today's show, is there an effective way that you can use the benefits that are provided for you in law of, one, your long-term capital gains, where you have a certain amount, a certain buffer, and also the setting off of losses that you might have in your individual stock portfolio or your equity portfolio to set off long-term gains down the line?
Yeah. So yes, definitely there are ways to optimize your taxes. So up to 1.25 lakh per person in a family. So suppose there are 4 or 5 members in a family are there, and you invest in all those names, those who are above 18 years of age. So you can definitely make a 5 lakh plus kind of a money, tax-free, legally and officially. So there is no hitch, and we do recommend and we do help our customers also to do so. We call it kind of a gain harvesting. So this is a common practice people do, and there are ways to manage this also. Before March, you have to manage this activity. Ideally, January, February month are good for this. We call it around budget to do this harvesting. The second thing is this SWP, which has come up over the years for the people, those who are in the retirement stage and they need regular income, they can also leverage this income of up to 1.25 lakh, which is exempt, and thereafter also 12.5% is the tax rate, which is now very, very lucrative. It was earlier 10%, but 12.5 is comparatively low if you see the income distribution and capital withdrawal comparing 30% tax if you are in a higher bracket. So we do recommend that also.
Yeah, I want to talk about that a little later in the conversation, because the next point, Sudhir, has to do with a dividend portfolio, and we'll also discuss the IDCW, or the dividend option in a mutual fund scheme, and whether that is better, or the SWP that you've just mentioned, which is a systematic withdrawal plan. But we'll come to that in just a bit, even from the tax perspective. But Mohit, a dividend portfolio, this is something a lot of people have dreamt of, have thought of, have aspired to have, because the dream is to have a stock portfolio that pays you regular dividends, and this takes care of all of your requirements in a year. Is this actually practically possible, or is this too good to be true?
Look, it is doable and possible. Having said which, in India, the dividend yield is pretty low, Alex. Right? The current dividend yield of the index is around 1.3 to 1.6% at best, which means that you need a pretty hefty amount of capital to be deployed to be able to run your household only through dividends, right? So it could be a good means, but it can't like really serve your full purpose unless you have a massive portfolio in equity, which is not possible with everyone, right? So yes, you can have dividend payout option in a mutual fund, which is also popularly or which is now regulatorily called an IDCW option, and you can choose the dividend yield funds. Typically, these funds have a decent payout ratio. They give a monthly payout of 1 to 2% depending on the nature of the fund, and the whole mandate is to invest in high dividend yielding stocks which have a high dividend payout, and per se the fund will also give a regular dividend, though it's not a mandatory condition, it's not an obligation on them to pay out dividend, but yes, the endeavor is to give dividends every month. So technically possible, but practically it's very difficult to build a solely dividend yielding portfolio in a country like India, which still is a growth economy and there are more growth companies than dividend paying companies.
Points that you're raising, and so just very simply, if you put a number to it, if you're talking about 1.5 to 2% dividend yield, if you have 1 crore portfolio, every year you can expect to have 1.5 or 2 lakhs that you receive, which is not necessarily very much if you think about it. Sudhir, the other aspect to consider is the tax, right? So what is the kind of tax treatment on dividends, both from your stock portfolio and IDCW, which is your dividend option of mutual funds?
Well, nowadays this has been simplified. It would be taxed as per your slab. So up to 12 lakh, if your income is low, so you can opt for dividend option also. But those who are in the higher bracket, we don't recommend them to choose dividend option or ICDS. So we don't recommend that also, income distribution, sorry. So we don't recommend as such because the tax level makes your returns of post-tax. You have to calculate post-tax returns.
Yeah.
Right? 30% versus 12.5%. So clearly we can see there is a 2.5% kind of a difference in the return.
So just to simplify this further, if you don't have a regular source of income and you are looking at this dividend as a primary source of income, if you have up to 12 lakhs of earnings, then it's beneficial because you're not paying any tax then. But there is an element of advanced tax, isn't there, Sudhir? If you're earning dividends above a certain threshold, you have to pay advance tax. Is that right?
So yes, if the income overall is not taxable, up to 12 lakh, there is no tax, no?
Yeah.
And after also, if you are saving some ATC or other investment, up to 12 lakh in new tax regime. But those who have home loan, other things, we have to see overall tax liability. If it is more than 10,000 tax liability, then you have to pay advance tax.
So if the overall liability on the dividend that you receive is more than 10%, 10,000?
No. Overall tax liability.
Yeah, so on the dividend that you receive, right?
Total income of an individual. If it is only dividend income, then of course dividend only, but generally people do have interest income also, sometimes they have salary also, they have pension also. So the total income tax liability is about 10,000, then once tax liability comes.
Got it. Okay, so fair point. All right. So let's talk about the other options, since the sense that I'm getting, Mohit, and also what I've heard in IDCW, which is your dividend option. I keep saying that interchangeably because a lot of people keep thinking about this as a growth and dividend. They call it the dividend option, but it's called IDCW now, which is income distribution cum withdrawal. But in that second option, Mohit, is it guaranteed that the mutual fund will give you a dividend on a regular basis?
Alex, it's a promise. It's not a guarantee. There is no guarantee in the world of mutual funds. In fact, I think the regulators hate the word guarantee. So there is no guarantee in any of the products which are financial products which are available in the market. So yes, it's kind of a unsaid thing from the fund houses that they will give a regular dividend at a fixed frequency. Having said which, if they run huge losses in the scheme, they are under no obligation to pay the dividend. only dividends can be paid out by the fund houses only from the profits on the scheme, right? And typically they have some profits always, so they are in a position to pay regular dividends, but there is no guarantee. An investor should be well aware of the fact that even though they are applying into an IDCW option in a very high dividend paying fund, there is a chance or a potential risk that they might not get dividend for a few months or for a period of time.
Okay, so therefore, the sense that I'm getting from both of you gentlemen is that the SWP, or the systematic withdrawal plan option, is better from a mutual fund portfolio to pay yourself a regular salary, especially when you don't have a source of income. So Mohit, first to you, how does this work and what are the benefits? How do you arrange for this? Is it better to go towards an equity mutual fund or like a hybrid fund with equity taxation when you're looking to pull money out on a regular basis down the line?
Look, Alex, I think it will depend on a lot of variables in your portfolio. It will depend on your age bracket, the kind of portfolio you have constructed. There is no harm in putting up an SWP option from an equity fund or an hybrid fund or a liquid or a debt fund, right? So it all depends on the profile of the final investor. Let's say if I take an investor who is about to retire, let's say you are at age 55, 56, your complete portfolio, or let's say bulk of your portfolio is equity, and you are about to retire in next 2 to 4 years, you might gradually want to shift that portfolio to more conservative options, and from those conservative options, and primarily that conservative option could be a balanced advantage fund or a hybrid fund. From there on, you can set up an SWP, which is a monthly redemption of your units, and take out the amount of capital plus profits, whatever you need for your monthly sustenance. The good part about an SWP is that when you redeem some portion of capital and some portion of profit both. So you're not paying full taxes on the entire amount of redemption. Let's say if you redeem 100 rupees, there could be 80 rupees or 70 rupees of capital and 30 rupees of profit. So that 12.5% long-term capital gain tax will only be paid on your capital gains, and that too after 1.25 lakhs every year, basically. So there is a lot of tax saving element involved out here, rather than taking a dividend option, which in case you were in the highest tax bracket, then you would have got it clubbed into your marginal tax rate and you would be paying a full tax on that. So SWP is a great option. You have a great tax advantage. The choice of fund will totally depend on your profile, risk appetite, the age cycle, and multiple other variables.
Yeah, but important fact. Sudhir, from a tax perspective, for those people that are in the know, it's called FIFO, what Mohit just spoke about, first in, first out, and that's one of the biggest advantages of the systematic withdrawal plan. You were making a point earlier about this very fact, I think. You want to make that point now?
So my point is, keeping money equity oriented will give you more tax advantage, because the tax laws are different for debt funds. So if you are keeping in debt funds, the tax rates would be different. The holding period would be 2 years minimum. So otherwise in equity, after 1 year, you can start your SWP. So that's the other difference. And generally people have a kind of a fear of equity market. The better returns if we can get in long term, 5 years, 10 years, 20 years, money has to be there, because life is not going to be end after 55 or 60. We have to live, generally people live 70, 80 years. So why look for a safer or I would say suboptimal return? So just leave that fear out and take benefit of equity, and SWP makes that kind of a risk also reduced, because you are using your capital growth.
Important point. Just to close out this conversation, Mohit, incidentally, I must inform you that we had a conversation yesterday about equity savings schemes, and a lot of mutual funds have the use of equity, pure equity. They use arbitrage as well to complete that equity component of the equity savings scheme, and then they use fixed income. But you get that 65% and you get that equity taxation. And so would you say something like this is okay to consider for somebody who's relatively risk averse?
Oh, yes, absolutely. Look, equity savings fund, aggressive hybrid funds, balance advantage funds, asset allocation funds, these are great choices for having your STPs going through. A, it gives the advantage of equity taxation, which Sudhir was alluding to. And B, it is more a conservative and a relatively safer way of parking your funds, because Look, your ultimate objective is to have regular stream of income, and that regularity with some safety, some conservative allocation can only be ensured with this category of funds. Full safety and full conservative allocation, then you go to debt, but you lose the tax advantage. So to get the tax advantage with some safety, then this is by far the best choice.
Great. I think it's been a fabulous conversation. Mohit, Sudhir, thanks so much for joining me today. Pleasure speaking with both of you. And that brings us to the end of this edition of Your Money Matters. Let us know what you think, and also don't forget to tell us what you'd like to hear on this program. From myself and the team that put the show together, thank you so much for watching, and this is NDTV Profit.